If you own a 100-ounce bar of silver, you just watched something happen. A few $100 in green reappeared on that one bar, off the low. Call it around $400 back on a single bar that you watched bleed just a couple of weeks ago. And if you are like most of the people I talk to, you are staring at that number right now and asking the only question that actually matters: what happens next? So let me be straight with you, right up front, because you have earned that, and because almost nobody else will say it plainly. I cannot tell you where silver goes from here. Neither can anyone on television, and the moment they pretend to, you should stop listening. But by the end of these few minutes, you are going to understand the one thing that actually decides whether that bounce means anything to you at all. And it is not the price. It is not the deficit. It is not China. It is something about the way you own your metal. And it is the difference between the people who are still standing when the bounce comes and the people who got carried out the door right before it. There is a single question that separates those two groups. One question. I am saving it for the last few minutes because it is the part that the people who want to sell you silver, and especially the people who want to sell you a leveraged way to own it, would rather you never think about. Stay with me and I will hand it to you. And once you have it, you will never look at a shakeout the same way again. Because here is the thing. A little over a decade ago, silver did something almost exactly like what it just did to you. And it taught a lesson that most people who own silver today have never once been told. Let me walk you into it, because you need to feel it, not just hear it. Go back to the spring of a year near the start of the last decade. Silver had been on a tear for months, a real one, climbing week after week, and it ran all the way up toward $50 an ounce. 50. That is a number with weight to it, because it is right up against the old record from 1980, the one every silver owner knows. People who had held quietly for years were suddenly rich on paper. The coin shops were busy. The message boards were euphoric. Everyone who had been laughed at for owning silver was finally the smart one in the room. And the story underneath it was real. Inflation was in the headlines. The dollar looked shaky. Silver was scarce and getting scarcer. If you owned it, you felt, for once, like you had done everything right. And then, over the span of a few days, silver fell by roughly a third. Not over a year, not over a few months, days. A drop so fast and so violent that it turned euphoria into panic before most people could even get their broker on the phone. Fortunes that had been real on a Friday were gutted by the middle of the next week. And here is the part I need you to sit with, because this is the whole lesson, and it is the part that gets left out of every version of this story you have ever heard. Nothing about the silver changed. Let me say that again, because it is that important. No mine flooded. No vault turned up empty. The deficit did not suddenly resolve. Demand did not vanish overnight. The metal, the actual physical silver sitting in vaults and safes and coin shops around the world, was exactly as scarce and exactly as real on the way down as it had been on the way up. Nothing physical happened. So what on earth knocked a third off the price in a matter of days? The exchange changed the rules on borrowed money. That is it. That is the whole story. The people who ran the futures market looked at how far and how fast silver had run, and they raised the margin requirements. Margin is just the amount of money you have to put down to hold a leveraged position, a bet on silver made largely with borrowed money. They raised it, and then they raised it again, and then again, several times in quick succession, over a stretch of days. And every time they raised it, every trader who was holding silver on leverage suddenly had to come up with more cash to keep his position alive, or sell. Think about what that does. If you are holding silver with borrowed money and the amount you are required to put down keeps going up while the price is falling, you get a margin call. And a margin call is not a suggestion. It is not a conversation. It is a demand. Come up with the cash by the deadline, or we sell your position for you, right now at whatever price the market will give us. And most of those people could not come up with the cash. So they were sold out, forced out. Not because they wanted to sell, not because they had changed their mind about silver. They were forced to sell, at the bottom, into the very drop that was destroying them, because the rules of holding had moved underneath them. And here is the quiet, brutal genius of it, the thing you have to understand. Forced sellers do not sell because silver is a bad idea. They sell because they have no choice. And when a wave of people are all forced to sell the same thing at the same moment, the price does not fall gently. it collapses. The forced selling feeds the drop, and the drop triggers more margin calls, and those trigger more forced selling, and the whole thing cascades down like a controlled demolition. That is what a third off in a few days actually looks like from the inside. It is not the market discovering silver is worthless. It is leverage eating its own. Now, here is the other side of that story, and this is the side that should change how you think about the bar sitting in your house or your vault right now. There was another group of people in that same crash, people who owned silver too. The same silver, at the same price, taking the same terrifying drop on the screen. And not one of them got a margin call. Not one of them was forced to sell a single ounce. Do you know why? Because they owned their silver outright, paid for, in full. A bar in a box, a stack of coins in a safe, metal in an allocated vault with their name on it. There is no margin call on a bar you already own. There is no phone call in the night. There is no deadline. The exchange can raise the cost of holding a bet all it wants. It cannot reach into your safe and touch metal you have already paid for. Those people felt the exact same sting you felt these last couple of weeks. They watched the number on the screen fall and their stomach dropped just like yours did. But they were never forced to do anything. They just held. And silver, in time, went on to do what silver does. That is the lesson from that spring, and it is the lesson for right now, and almost nobody will tell it to you this way. The danger was never that the buyers were wrong about silver. The danger was leverage. Leverage is the thing that turns a scary drop into a forced sale. It is the mechanism, the trapdoor, and Wall Street builds it right into the products it sells you, precisely because a forced seller is the most profitable customer there is. The people who owned the metal survived. The people who owned a leveraged bet on the metal got destroyed. And they got destroyed at the exact moment they were most right about the long-term story. So let me connect this straight to the number you were looking at, the few $100s of green that just reappeared on your bar. Silver just came through a hard, ugly shakeout. It got knocked down into the mid-50s, its lowest in the better part of a year, a fast, violent flush that came on top of an even bigger fall from its record earlier in the year. And now it has snapped back up towards 60, recovering a good chunk of that drop, which is exactly why that $400 reappeared on your 100-ounce bar. Gold, meanwhile, barely flinched by comparison, reclaiming the $4,000 line it kept defending. So calmly, it makes silver look unhinged. And that gap, a small gold move against a violent silver one, pushed the gold to silver ratio up into the 70s before it eased back toward that line, as silver led the way back up. You want to know what just happened in that shakeout and bounce? You watched the same movie from over a decade ago play again. The leveraged got shaken out into the mid-50s. The forced selling made the drop worse than it should have been. And the people who owned their metal outright, who could not be forced to do anything, simply held through it and are now watching the green come back. That $400 did not appear because you were smart about timing. It appeared because you were still there to see it. That is the entire difference, being there. And that brings me to something that matters, especially if you are sitting on $100,000 or more in a retirement account, a 401k, an IRA, anything like that. Because this is exactly the kind of moment where what you own and how you own it decides everything. I put together a free retirement protection guide for precisely this reason. It walks through in plain English how retirees are moving a portion of their savings into physical gold and silver, metal they actually own outright, rather than a leveraged promise on a screen, held inside the tax-advantaged account they already have without triggering taxes or penalties along the way. It covers the quiet mistakes that force people to sell at the worst possible moment. It is completely free. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. And if you go through it and want to go deeper, there is a free, no-obligation, one-on-one educational session for folks with $100,000 or more in any retirement account. Just answers. No pressure, nothing to buy. Okay, now let me show you why this matters even more than you think. Because the story is not just about surviving. It is about what you are surviving for. Here is the part that actually changes things. And this is where most people stop paying attention, right when they should lean in. Everything I just told you is about not getting shaken out. But why bother holding at all? Why is the metal worth surviving for? Because the reason silver keeps having these violent shakeouts and violent bounces is the same reason serious people keep buying it, and the two are the same coin. Silver has run a structural deficit for 6 straight years now. The world uses more silver than it mines, year after year, and it has been covering the gap by draining above ground stockpiles. Hundreds of millions of ounces pulled out of vaults to plug the hole. That is not a trader's opinion. That is a physical fact, and it is a fact that gets worse every year because so much silver now gets consumed and destroyed. It goes into solar panels in flex too thin to ever recover. It gets soldered into 1 billion devices and thrown in a drawer. Gold gets hoarded, and nearly all of it still exists. Silver increasingly gets burned. And you can see the demand pulling hardest in China, which has been draining the physical silver market, its imports surging to record levels, its domestic inventories drawn down so hard that at one point silver inside the country traded at a steep premium to the price in London. When the price somewhere runs above the world benchmark, it means metal is being physically pulled toward it faster than it can be replaced. That is real tightness, and no exchange rule can unburn a panel or refill a drained vault. So, the honest bull case, and I want to be careful to give it to you as the case a growing number of serious analysts are making, not as a promise from me, goes like this. They look at that ratio, up near 70, and they note that a stretched ratio has historically tended to compress, and that it compresses because silver outruns gold, which would mean silver rising sharply just to close the gap. They look at 6 years of deficit that is not resolved. They look at the fact that silver is a tiny market, so a small shift of big money into it moves the price hard. And they will tell you that triple-digit silver is no longer a fringe idea, that mainstream forecasts now sit well above where silver trades today. Some of them put out numbers that would make your eyes widen. And I am not here to talk you out of any of it, because the setup is genuinely compelling, and understanding it is the reason you own the metal in the first place. But now I am going to keep the promise I made you at the top, and be honest about the risk, because I am not interested in selling you a fantasy. I cannot promise you a price. I cannot promise you a date, and anyone who does either one is lying to you. Full stop. Silver is the most violent major metal there is. It overshoots wildly on the way up and just as wildly on the way down. It just proved that to you, shaking down into the mid-50s and snapping back towards 60 in a matter of days, and it can turn around and do the exact opposite just as fast. That $400 that reappeared could vanish again next month and reappear again the month after. A few good days off the low is not a confirmation of anything. Silver could stay cheap. It could fall back below where it just bounced from before any of the long-term story plays out. And even if the people making the bull case are completely right about where silver ends up, the road there can take years, and it can be brutal. And being right and being early feel exactly the same while you are holding through the drawdown. In the short run, the price does not answer to the deficit or to China. It answers to the Federal Reserve, which under Kevin Warsh has turned hawkish, with a rate hike now a live possibility rather than a cut. And metal that pays no interest always struggles when rates threaten to rise. The shortage is the trend. The Fed and the dollar and fear are the weather. And the weather can soak you for a long, long time before the trend ever shows its face. Which is exactly why how you own your silver matters more than where silver is headed. Because if the road is going to be that violent, then the only way you ever collect on the long-term story is to still be holding when it finally arrives. And that is not about being smart. It is about being unforceable. So let me get concrete about your own position, because principles are worth more to you here than any prediction. 3 things. First, own the metal, not a promise on it. Own it outright, paid for, in a form where nobody can send you a margin call, and nobody can change the rules of holding underneath you. The people who survived that spring over a decade ago survived because they owned the thing, not a leveraged bet on the thing. Second, size it so that a shakeout can never force your hand. Own only as much as you can watch fall by a third without having to sell a single ounce to cover anything else in your life. If a drop would force you to raise cash, you own too much, or you own it the wrong way. Third, and this follows from the first two, never sell into the bottom. The only people forced to sell the bottom are the people who borrowed to hold it. If you own it outright and you sized it right, a shakeout is just weather. You get to wait it out. You get to be there when the green comes back, the way it just came back on your bar. And now let me hand you the one question I promised at the very top, the single question that separates the people still standing from the people carried out the door. Here it is. If silver fell by a third tomorrow, could anyone or anything force you to sell? That is it. That is the whole game. Not what is the price target, not is the bottom in. Just that. If the answer is no, if there is no margin call, no loan, no deadline, no obligation that could pry your metal out of your hands at the worst possible moment, then you have already won the only battle that matters. And the shakeouts are just noise you get to ignore. But if the answer is yes, if there is any leverage, any borrowed money, any structure that could force your hand, then understand this clearly. You are the one they shake out. You are the machinist forced to sell at the bottom. You are the leverage trader getting the margin call, while the guy with the bar in his safe sleeps fine. The shakeout machine is not built to find out whether you are right about silver. It is built to find out whether you can be forced. Make the answer no, and it has no power over you. That is what comes next, by the way. That is the honest answer to the question you started with. What comes next for silver in the short run is unknowable, and anyone who tells you otherwise is selling something. But what comes next for you is entirely in your hands, and it has almost nothing to do with the price. It has to do with whether the next drop can force you to sell. Get that right, and it does not much matter when the long-term story pays off, because you will be there to collect it. So here is where I want to leave you. If you are on your TV, the QR code is on your screen one more time. If you are on your phone or your computer, go to jeffradeguide.com. It costs you nothing to be informed. And the smartest time to think this through calmly, to make sure a shakeout can never force your hand, is exactly when nothing feels urgent, which is right now, in the quiet after the bounce, not in the panic of the next drop. That is the whole point. The calm decision is the one you make before you need it. And for those of you who stayed with me all the way to the end, here is something just for you. If you have $100,000 or more in any retirement account and you mention that you watched this full video, you can claim a free, one-on-one, no-obligation educational web conference. A real conversation about your specific situation, about what you actually own versus what you only think you own, with no pressure and nothing to buy. That is only for the folks at that level who made it all the way here, and you are one of them. Because think back to that 100-ounce bar and the $400 that reappeared on it off the low. That money did not come back to you because you called the bottom. Nobody called the bottom. It came back because you were still holding when the bounce arrived. Because nothing and nobody could force you to let it go in the dark. That is the entire secret. Do not try to be the smartest silver owner. Try to be the one who cannot be forced out. Because the ones who get rich on silver in the end are never the ones who are most right. They are the ones who were simply, stubbornly, still there.